All right, Real Estate Runway family, welcome to yet another episode of the Real Estate Runway podcast powered by Quattro Capital. And I'm joined today with a very distinguished guest, Mr. Neal Bawa. Neal, how are you today? Welcome to the show, sir.
Fantastic to be on the show, Chad. Thanks for inviting me.
Thank you. Thank you as well. Well, I guess to get started, your reputation precedes itself. And as you heard, as everyone just heard in the introductory part there, you are well renowned as one of the data geeks of multifamily, just like, I kind of call myself that as well, but you are very much more well known in that fact. So what I'd love to get into is, what are you as Grow Capitalist seeing in how the debt market of today is, possibly changing the route of multifamily value add as we know it.
I think the first thing that I like to say, we're recording this in August, the end of August, probably will come out in September, is that it's early days. I think that one of the key problems with the way folks make decisions in real estate is they mistake real estate for stocks or crypto. The stock market and the crypto market is a real-time response mechanism. The Jerome Powell, the chairman of the Fed, will say something and the stock market will crash 30 minutes later or go up 30 minutes later. It's a real-time mechanism. Real estate is extraordinarily slow. We're snail-like in our pace. Everything happens at a very slow pace. And so as of the end of August of 2022, we're still at the beginning of this process, right? There's a lot of people who have said publicly, well, prices haven't gone down. The answer is, how could they possibly go down? I mean, we're very early in this game, right? So everything happens in quarters and years in real estate. So that process is moving forward and it takes time. So what you're seeing today in the debt markets is not the culmination of that process. It's not the bottom. It's not the process to the bottom. We're just somewhere in that process, early on in that process. And early on in the process, the debt markets are very confused. The lenders are very confused. They're not sure they're not sure where the bottom is. And so it's normal for them to become extremely conservative, which means that LTVs drop, which means that rates increase, all kinds of crazy stuff happens. They stop, the LTVs or LTCs for construction projects will decrease. They want more liquidity. That's what we're seeing in this marketplace. So I'm going to say something that might appear bizarre at first, when I say it, but then really think about what I'm saying. I would much rather have the lenders of the bottom than the lenders of today. I would much rather have that lenders at the bottom, and we're nowhere near the bottom, right? And the economy is not in a recession. We're 3.5% unemployment. I'd much rather deal with those guys. You know why? Because they know at that point that this is the bottom, because the Fed's done, because the Fed's now talking about potentially cutting rates, and those lenders, I can actually get better deals from them than today. So we're in this flux time, and during the flux time, it's all a deal by deal thing. I was absolutely delighted today. We did a Fannie Freddie rate, the deal today, and it came in at 3.4%, right? And it's floating, so it'll go up. But today, having already seen all these increases to be at 3.4%, I was absolutely delighted. My underwriting was at 4.75, right? Oh, sorry, 5.75, because I had no freaking idea, right? No clue where I'm going to start on the day that they send me this information. And my next deal probably could be 1 or 1.5 points away from this in some direction. Who knows? So I think that if you're in this market today, and if you're a syndicator, let's say that you were the richest syndicator today, you simply wouldn't play. The people that are playing have a need to play. Otherwise, people just step down and wait until the market shakes itself out. That's the truth.
Yeah, all good insights. And, I love a couple of points you said there is, real estate happens in quarters and years. And everyone has been questioning, why are we not seeing price reductions? Well, guess what? Every time there is any sort of a change in price expectation between buyers and sellers, in my opinion, it takes 6 to 8 weeks for that to settle. We have had a change about every 6 to 8 weeks since January. And so there is no settling in price expectation at this point. We can argue whether or not supply and demand will permit that to happen, and that's a whole nother topic. As you mentioned something before about having the lenders of tomorrow, knowing when we are at the bottom. So it's very clear that Mr. Powell has a major lever he is trying to use, and that is interest rates to, cool off what has become an inflated economy, just for very simplistic terms, right? We have endured what, we initially thought to be normal and now relatively historic rate increases. But you've been in this game a long time. I've been in this game a long time. The rates we're feeling today are, in my opinion, and based on data, just now getting back to where we were in pre 2019 days, right? So it's not that we're getting
Yes.
into historically high interest rates. What are your thoughts on, a, whether this is a reasonable period to consider rates to continue increasing for a while, and B, you know, when you map out, using Fred or something, all of the recessions and history of the Fed versus rate hikes and rate increases, it seems they're on the clock for a rate increase. So there may be, some relief to come in the next 2 to 3 years. What are your thoughts on those two things?
So I love looking at historical data because it tells me a lot, right? So the Fed's raised interest rates 9 times in the last 61 years in modern history or modern economic history. 8 times, all 9 times, they managed to kill inflation. So they are very good at killing inflation. I have no doubt that they will kill inflation this time as well. There's always people saying this time it's different. 1982, oh, oil is very expensive. Saudi Arabia can screw us, so it's different. It was never different. They always kill inflation because inflation is simply an expectation of rising prices. Inflation is simply a non-logical emotional conversation that buyers and sellers have. So when at some point the Fed breaks the back of that and inflation dies down, it may be harder to die down this time because of certain characteristics, especially supply chain, and the fact that we have a very large retirement cycle that happened in the last 2 years. So it might take more time, but the
Mm-hmm.
Fed will prevail. Equally, important is to know that in the last 9 times that they did break inflation's back, they ended up breaking the economy's back 8 times. So there's a single instance of the Fed having a soft landing. Because the truth is, what is the way that you bring inflation down? You reduce demand. To reduce demand, you essentially choke the life out of the economy, bring the economy to its knees. And once it's on its knees, obviously at that point, demand is low or inflation comes down simply because everyone's order book is going down. Now, the part that everyone forgets is that the Fed plays a role immediately after it chokes the economy and brings it to its knees. The Fed is what brings the economy back to a standing level. Because if they don't, then you go from a recession into a depression. So when the economy is on its knees, it usually goes into a 6-month recession. These kinds of inflation-based recessions. We're not in a real recession. Demand's very, very strong in the U.S. So this is a forced recession or an artificial recession based on, reducing inflation. Those in history tend to be very minor, and they tend to be about 6 months, sometimes 9 months long. They don't do any lasting damage to the economy that I've ever seen. And the Fed basically ends these recessions because it increases demand by cutting interest rates. So there's no evidence that the Fed has ever basically raised rates and then held them high, because holding them high would mean that the economy would go into a depression, and the Fed doesn't want that. So be aware that all rate cycles are sharp up, sharp down, almost no plateau. We saw a plateau once in 2007. That was a mistake on their part. It was 9 months long, and they put us into the Great Recession. So I doubt that this Fed is dumb enough to put us into a Great Recession. They know what happened in 2008. So I think it'll be sharp up and sharp down. So we think the Fed will be pretty much done by the end of this year or January at the latest.
Yeah, I think you're absolutely right, Neil, and that kind of supports the comment I made earlier about, the average. If you look at the historical data, it does tell you things. It is not indicator of, past performance is not indicator of future performance. However, the Fed has 100% of the time, within an average of 2 years and a max of 3 years, initiated its first rate cut after its first rate hike. So as of January, we are on the clock. So you lucky people out there who may have done some loans at the beginning or end of last year, you're probably going to be refinancing in a pretty great time. Hopefully, we'll see. But depending if you did short-term bridge, but we'll see. So anyway, I think your points are all very valid in that this is an artificial recession, if we're even in one yet. I mean, it's arguable. I heard you talk about the unemployment number still being 3.5. That's true.
You
We
can't
were
be in
in
a
a
recession at 3.5% unemployment. So I think that you can't find an economist right now worth their salt that will declare a recession. They will all say there's one coming.
signs of recession. Fair, fair. We were in a very similar one in 2020. And I think if we all look back, I feel like I may have even seen you on the record saying this as well, that, what we're doing to liquidate the machinery that is the economy in 2020 by printing money into the system will cause this at some point. And all we're doing is living the obvious cause of, doubling the world's money supply in 18 months, or the country's money supply. So this is all expected, folks. We're coming right back to reality. We were in Disneyland of interest rates for the last 2 or 3 years, which has been
We've
great.
been in heaven. I mean, we've been in real estate heaven, and that doesn't last forever. So now it's time to live the reality of that money that got pumped into the economy.
Hmm.
It had all these positive consequences, and it also has negative consequences. So we're seeing those now.
You're right. So let's get off the doomsday train. I mean, I think we know what's happening. We know it's real, and it has to happen to a point. What goes up must come down in some respect. And this is a nature of fiat currency and elastic currency, which we've talked a lot about on the show. So looking forward, what is a company like Grow Capitalist doing to try and produce yields into the future for its investors? Are you still playing in value add space? Are you looking at other commercial real estate assets? Where is your head on where the money is to be made in the future?
So on the value add space, which is our favorite, just like it is everyone else's, we are playing as little as we can get away with. And what that means is the demand amongst our 800 investors that are invested on the value add side is still strong, even though it's dropped a little bit because yields have dropped. We're forecasting lower returns now than we were, but still it's very strong. So we're basically doing, let's just say, the minimum that we can, and then that keeps our investors from just simply walking away from us. Um, and they are well aware of what's happening because we do 26 webinars a year to let them know about what is happening, right? So we've got a massive webinar platform. We've got 30,000 people attending our webinars. And so they know what is happening in the marketplace. And so they're investing with open eyes. We're looking for other methodologies, other methods to make numbers work. So one of my favorites that I have multiple examples of is called super value add. We're now looking to buy properties in tertiary markets, not secondaries, not primaries, tertiary markets that are the land is zoned for a lot more units than have already been built. And if that market has already crossed, let's say, 175,000 a unit, then we go in there and we convince the city to let us build more units. So we have a project that we built 29. We have a project where we're building 42, or maybe it's 39 units. And so by doing that, we completely artificially juice the returns because we manufacture an additional number of units that so that when you exit the property, you basically just have 30 or 40 more units. So that's called super value add. We're not aware of anybody else doing it because you need an in-house development team. Luckily, we have $800 million of development projects, so that development team provides its time for these mini projects pro bono. We actually don't pay anything to that development team. They just come in and do these like nice little projects as they're doing the big ones. So that's a strategy, and it works really well. Works all the time. Really, it's just painful because you're putting in a colossal amount of work to build 30 units and to build 100 units. It takes the same amount of time and the same amount of effort from our development team. I'm sure that there's less people working at the site, but our time is exactly the same. So it's painful. I'm doing it because I have no choice. Um, so that's one. The second one is that we are looking at trends outside um, of multifamily and development, and we've been doing that for a while because the one problem is, and I really take issue with more people not saying this in podcasts, is that the entire multifamily value add ecosystem has a time limit on it. So there's only so many properties that can truly be value added in the United States. And over 90% of that value add, in my estimation, and this is a estimate number, this is not a mathematical number, so keep that in mind. I believe that over 90% of those value adds have been done. Some properties have been done 3 times. The same property has now had 3 different value add buyers come in and add value. So the total amount of value that you can add is has been massively reduced, right? So there's not much left there. And so people believe that this will just go on for the next decade. And I laugh at that concept. That idea is ridiculous and has absolutely, it's a fairy tale fantasy. It cannot happen because otherwise, basically, there's going to be 20 syndicators fighting over every property. And we know what happens when 20 people fight over every property. Already there's 4 or 5 or 6 fighting over every property. So it's already problematic. It's already creating bubbles in the marketplace. I tell people multifamily is not in a bubble. Multifamily syndication is definitely in a bubble because syndication is about 5% of the overall multifamily market. So take that comment for what it is. In my mind, you have to look outside. So when I look outside, I see two opportunities. One that I am going to go live with today. So you're actually the first podcaster to ever hear about this. Okay, so the one opportunity that people know about publicly, I'll go with that first, is called build to rent. So America's changing, and today nobody wants to build multifamily if they're a $10 billion or $100 billion company. Everyone exclusively is only building BTR, build to rent. And built to rent essentially is townhomes or small single family homes, like 1,000 square foot single family home built from the very beginning, for rent in 100 and 200 unit communities. And here's what I can tell you, and this is information that you must not have heard of yet. The old standard was that we would build 200 or 300 units of multifamily, right? You see that all the time. You know what the new standard in America is? 1,000 unit built to rents. There's about 100 of those
Yes.
on their way. 1,000 unit built to rent communities are our new reality. So the fact that there's people in the syndication industry who think that BTR is a fad is completely laughable. They're clearly in an echo chamber, and they'll come out of it sooner or later. BTR, for all practical purposes, is the new way of doing multifamily, in much the same way as electric vehicles over the next 5 years will be the new car, right? So there's going to be coexistence for a long time. Probably there'll be gas cars driving around in 2040, but nobody in their right mind would buy a gas car in 2035 or 2040. So there's a transition happening with BTR basically becoming the new multifamily. And because it's still in the first 3 years, I am very heavily into that transition. As you know, I have over 1,000 units in construction at this point. But the second part that I'm interested in, this is the first time I'm ever talking about this in public, is what is the single greatest wealth builder in real estate, right? That question is a very loaded question because I answer it 20 or 30 different ways. So I'm going to change it. I'm going to say, what is the single largest geographic wealth builder in real estate? The answer to that is water, right? So you can have a $10 million mansion on water, and if you go 4 streets over, that same mansion is 2 million. And if you go a mile away, that same mansion is 1 million. So million, 2 million, 10 million. Water is the biggest single factor that drives real estate prices, correct? Right? I don't think anybody would argue that because people buy 10 million and $100 million properties simply because they're on the water. People buy islands for hundreds of millions of dollars, right? So there's nothing like water. But the problem is there's not enough water, right? So less than 0.1% of all real estate in the United States is on beaches. But for the first time in the world's history, we now have the ability to bring the beach to people. So over 100 companies over the last 3 decades have tried to figure out how to build what is known as a lagoon. A lagoon is a beach, but much better. Why? Because it doesn't have waves, you can't drown. The water is transparent or translucent, and it's about 4 feet deep. You can have water activities. The problem with all of these lagoons was concrete. The cost was too high. But a company based in Chile, South America, figured out how to use nanotechnology to build lagoons for 1/10 the cost of anyone else. And today, no major development company in the world is considering building these 1,000 unit communities without a crystal lagoon. The greatest single opportunity in real estate is Crystal Lagoon, because for the first time in human history, you can bring the beach to people and not charge them $5 million for a single family home and not charge them $10,000 a month for rental, right? So look up Crystal Lagoons and you'll immediately notice Disney. What the heck is Disney doing? Disney is not a real estate company. Yes, they are. They're building a
They
multi-billion
absolutely
dollar
are.
community in Orange County anchored around a 12 acre Crystal Lagoon. So it's built around the lagoon. They're also building one in Florida, right? That one's a 7 acre Crystal Lagoon. One of the most famous companies in the world for real estate is MR, EMAAR. They built the Burj, the tallest building in the world, and also built all of the buildings around it, right? So MR is very famous if you go to Dubai. They're building 17 Crystal Lagoons at the same time, over 10,000 units. Everyone in the world's figured out that for the first time in human history, you don't have to do what Dubai did, which was reclaim the ocean, right? What essentially, if you remember, the Palm Jumeirah is what the world's most expensive real estate project, because they had to basically dig into the damn ocean to build that much beach facing property. And now you no longer have to do that. Imagine being able to build a Palm Jumeirah on regular land 5 miles outside Houston, right? And if you want to know who's doing it, Lanteas, Landtejas, 1,000 unit communities, all anchored around Crystal Lagoons. It changes real estate forever because we've never had the ability to have rental property on water.
I'm waiting for the continued mic drop moment. I love just hearing you talk, Neal, because the way the directions your mind goes is just incredible. So that is, wow. So I think about how to respond to that. Backing way up to what you were saying before about, build to rent not being a fad. Totally agree. Been harping on that myself. For groups that are not in construction right now, it looks like a futuristic thing, and it is. 20 years from now, that'll be maybe what people are adding value to, or if it is a fad and we're all wrong, it'll be what's being sold off and bought and sold off in chunks. We'll see the condo method, if you will. So that I agree with you. That is here to stay. But what you just included in there is kind of something that just logged into my brain for maybe 5 to 10 years from now, when some of these projects are no longer brand new builds. Some of these 1,000 unit communities will be built around. You said Crystal Lagoon. Crystal is what it's
Yes,
called.
a public-private crystal lagoon that's open several days a
Crystal.
week. So there are 55 in construction worldwide, including
Mm,
20 in Dubai. Dubai is Dubai, right? They have to
of
do
course, Dubai is
everything at
Dubai.
a completely crazy level. In the US, Texas, and Florida, Florida and Texas, in that order, are building the biggest ones. The one that is the first one that is open in the US is in Florida, and is
Mm,
currently making a shitload of cash, because what they do is multiple days a week, they open it to the public, right? As
mm.
a public amenity, and the rest of the time it's for residents. So, but there are currently dozens of those communities built. I have personally spent $1 million of my pocket to lock down an exclusive contract for my market. No one in that market can build a Crystal Lagoon without buying it from me. It cost me
Very good.
exactly $1 million to do that.
Very good. That'll probably be worth a lot more in the future, huh, Neal? Well, fantastic. This is, I know we're running short on time here. I'd love to keep you on for the next hour, but this is a busy guy. He's got to get back to running that empire of his at Grow Capitalist. So thank you so much for coming on, Neal. I'm going to skip the questions part here in the end. As always, we really appreciate you coming on, sharing your data, sharing your outlook, and sharing, just what it is that Grow Capitalist is up to in the future. Thanks for the tip on the Crystal Lagoons. That's a very interesting one. And I'm assuming we'll see you continuing to build BTRs and perhaps doing some super value ads as quoted going into the future.
Absolutely. And you can learn more about Crystal Lagoons and also about both BTRs and Super Value Add at multifamilyu.com. So that's multifamily followed by the letter u.com. And that's where our 26 webinars a year are stored. So check out, there's some other ones that are very interesting as well.
Very good. I'll second that as a great place to go. And Neal, should anyone want to reach out to Grow Capitalist to be part of your projects or to, seek value in any way from what your team can provide, what is the best way to get in contact?
Luckily, I'm the only Neal Bawa on the World Wide Web. So simply Google my first name and last name. You'll find your way to me fairly quickly.